Hey guys, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency Batch. I'm your friend, your mentor, CS Saurabh Jindal from KSJ Teaching, coming up with another wonderful session of Economics of Finance for all of you. Okay, so now what we have been discussing about, the money supply, sir, right? So in the last lecture, we studied about that how do we measure the money supply, which is very important, right? How are you going to measure the money supply? Again, one of the most important matters. So we'll discuss about this monetary aggregates, the new monetary aggregates, liquidity aggregates, and the reserve money. Now there comes a topic that is determinants of the money supply. Then we have the concept of money multiplier. Then we have the concept of the money multiplier approach to money supply, right? So all these three topics are interlinked, they are interconnected to each other, right? So what I am going to do is, I'm not going to directly read it from here. What I'm going to is, I'm going to explain it to you with the help of a flow diagram, and then after that you people will read it on your own from the books, right? You will be able to understand. That is my guarantee to you people. The few things we'll keep on seeing from the books. All of you must be having the books for this batch, as I told you, right? And if you're not having the books, that means you have not invested in your future, and that is really disappointing from the youth of the country, which is considered to be the best, the future for the country. And if you people are not investing in your future, then I think the future of the whole country is going to be in danger. Okay, so all those who want to still order the books, they can order it from our website. The link is there on your screen. That is www.ksjteaching.org. Basically, what you are getting is, in the price of handbooks, you're getting the free course. You're getting the full course in just the price of handbooks. And if you're not ready to invest that much also, so that's really difficult to understand. And one more thing, I think you people must see some doctors, sir. Why, sir? We are absolutely fine, sir. Why are you saying that we should be seeing the doctors? No, you people really need some treatment. No, sir. We are absolutely fine. Oh, sir, you must be, telling about the exam stress and the treatment for that. No, I'm not talking about that. I'm talking about that you people are watching the videos, but you people are not liking the videos. You're not hitting the like button, you're not sharing with your friends. So that means you must be having some serious pain in your fingers, right? Or else I don't see that it's a very difficult task to do it. You must be having some serious pain in your fingers, sir. Please go and check with your doctors. This is a very serious problem, right? You must be, your parents must be concerned about it. You need to check it out. Okay, sir, now we are going to discuss about this money multiplier and the determinants of the money supply. Now, what he is saying is, he says when we are talking about the money supply, that is how much of the money will be in supply in the economy. He says that depends upon the various behaviors. Okay. Sir, what are those behaviors, or whose behavior it depends upon the money supply? Sir, it depends upon the behavior of three different entities, right? So he says it depends upon the behavior of the central bank, right? Money supply depends upon the behavior of the central bank. Then money supply depends upon the behavior of the commercial banks, and the money supply depends upon the behavior of the public. Clear? So these are the three entities on whose behavior the money supply in an economy is dependent upon. Sir, how it is dependent? Please explain that. Now try to understand that how the central bank is creating the money. Sir, central bank is creating, or is controlling the supply of money through the printing of currency, right? That is one thing. That is through, I can call it as what? The money which is supplied, which is given by the central bank, is known as what? We have already discussed about it, sir. It is known as high powered money, right? So central bank is, contributes to the money supply in the form of stock of, high powered money. Now, what will central bank do, sir? High powered money is the money or the currency which is being issued by the central bank. Now, what the central bank will try to do, if he wants to control the supply of money in an economy, they will reduce the high powered money. And if they want to increase the supply, they will increase the high powered money. This is how the central bank, this money supply depends upon the behavior of the central bank, that how central bank is treating the high powered money. Now, if you talk about this high powered money, it is denoted by capital H, or it is also denoted by MB. Clear? Both these terminologies are given to the high powered money. So this was the first behavior, that is the behavior of central bank. Now comes the behavior of the commercial banks. Now this is very, very important for you people to understand, that how the behavior of commercial banks that help in identifying the money supply, right? Now, how the commercial banks create money supply, we have already discussed about it, through the process of borrowing and lending. Through the process of borrowing and lending, right? So this is how the commercial banks contribute to the supply of money in an economy. Now, what does it mean? Try to understand. Sir, Mr. X deposited rupees 10,000, right, in, let's say, SBI. Now, what can SBI do with this 10,000 rupees? Now, this SBI can lend 10,000 rupees to Mr. Y, right? But here, the conditions imposed by the central bank play a role. Now, the central bank says, now here, there is a condition by the central bank. The central bank says that you cannot lend this 10,000, right? Out of this 10,000 that you have received as a deposit, you have to keep 20% as reserves with central bank. Sir, why is it being done so? Sir, to secure the liquidity. Secure liquidity means, now if you give 10,000 to Mr. Y, tomorrow Mr. Y defaults. Now what will happen, sir? The liquidity of the economy will be impacted. Those 10,000 money is out of economy. So the central bank says you cannot lend the whole of money. 20% you should be keeping as reserves with the central bank. So how much money this SBI can lend now? This maintaining the reserves, he can lend 8,000 now. This maintaining of the reserves with the central bank is known as what? This is known as required RDR, right? RDR means the required deposit reserve ratio. Required deposit reserve ratio. Required deposit reserve ratio, right? So this is what the RBI says. The RBI says that whatever is your deposit, you cannot lend the whole of your deposits. Some part of your deposits must be kept with the central bank as reserves. The commercial banks have to comply with that. The commercial banks cannot say, no, sir, we are not going to keep it. We are going to lend 10,000 rupees. No, right? The commercial banks cannot say that, sir. That is not in their hands. So this is RDR, that is the required reserve. This is denoted by small r, and the small r says what is this small r says that out of the total deposits, what are the reserves being? The ratio of reserves to deposits, right? That means if you have deposits of 10,000 and you are keeping the reserves of 2,000, that means this R is 20%. That out of total deposits of 10,000, 20% is required to be kept with the central bank or with the RBI, right? Now, what will be the money supply? Can you tell me now what will be if 20,000 is kept with this central bank? What will be the money supply here? The money supply will be how much? That will be 8,000 rupees. That will go into the economy, right? Now here one more point is there, sir. One more point is there. What, sir? Here the central bank says that you have to keep Out of the 10,000 rupees, you have to keep 20%, that is 2,000 rupees. The commercial bank says, no, no, sir. The commercial bank says, no, no, sir, we will keep reserves of what? Reserves of rupees 3,000 instead of 2,000, which is required by the central bank. The commercial bank says, no, we are not interested in keeping only 2,000. We want to keep 3,000 rupees as the reserves, right? So here what we are going to have is, here we are going to have excess reserves. Here what we are going to have is excess reserves of how much? 1,000. And this excess reserve is denoted by small e, right? That is, what is the amount of excess reserve out of the total deposits of 10,000, right? So 10% is your excess reserve out of the total deposits. Clear? Any doubts up till this point? Right, so this is the RDR, that is the required deposit reserve ratio, and it helps in determining the money supply, because higher the RDR, lower will be the money supply. Higher the RDR, lower will be the money supply. What I am saying? I'm saying, sir, higher the RDR, higher deposit ratio, lower money supply. Sir, why? Higher RDR means the commercial banks will need to keep more money with the central bank, right? Commercial banks will need to keep more money with the central bank, and they will have less money for lending. The money supply is created when there is more money for the lending purposes available with the commercial banks, and lower RDR means the higher money supply. Clear? So these are the terminologies that you need to remember, small r, small e, because all these things we are going to use in the concept of money multiplier. Clear? So this is the required deposit reserve ratio. Now I say one thing, sir. What, sir? Now if we talk about RDR, that is the required deposit reserve ratio, that the banks have to keep some money with the central bank and another money they have available for lending, right? Now this RDR has cost also, and this RDR has benefits also. Sir, what is the cost involved with the RDR? This is the opportunity cost. This is the opportunity cost. Sir, how this opportunity cost is there? Let's say Mr. X deposited 10,000 rupees in the bank, right, in SBI. Now this SBI is going to lend this 10,000, the whole of 10,000, right, at the rate of 10%, right? Rate of interest is 10%. So what is the rate, what is the interest that they will be earning? 1,000 rupees, right? Now the central bank says you cannot lend 10,000 rupees. The central bank says you have to keep 2,000 with us, and you, how much you can lend, right? He says lend only 8,000 rupees, and the rate of interest is 10%. That means what is the interest the commercial bank will be getting? 800. So there is a loss of this 200 rupees of the interest, and this is known as opportunity cost, right? This is known as opportunity cost. Sir, what are the benefits? The benefits is reserves help in maintaining the liquidity. Reserves help in maintaining the liquidity of the economy, right? So in case anyone defaults, right, you have the reserves, reserve money is there. Clear? So it helps in maintaining the liquidity. That means the RDR has the cost also and the benefits also. What is the cost involved? That is the opportunity cost. And what are the benefits which are involved? That is, it helps in maintaining the liquidity in the economy, right? Now the question is, how do you decide this RDR? What are the parameters on which this RDR is decided, that what should be the RDR, or whether it should be increased or whether it should be decreased? Are there any parameters on which it is dependent? Yes. Whether involving the cost or benefits, we say the RDR is dependent upon two broad parameters. What are those two parameters? One is the market interest rate. One is the market interest rate, And the second parameter is what? The second parameter is expected deposit outflows. Expected deposit outflows. Sir, what does it mean? The market interest rate means if this interest rate in the market is high, what will the banks prefer? The banks will prefer to keep the low RDR and lend more and more and money, because that will lead to what? Generation of more interest, right? If this interest income, this is what? This is an income from the viewpoint of the bank, right? That is why 200 is called as opportunity cost. This is an income. Now he says if the market interest rates are high, right, the DRR should be low or what? Yes, sir. If the market interest rate is high, your RDR should be low, right? More and more money should be available with the commercial banks for the lending purposes. Clear? Now, coming to the second point, that is the expected deposit outflows. Now, Mr. X deposit 10,000 rupees in his account, and during the festival days, let's say it is Diwali days, during the festival days, now what he will do? He will prefer withdrawing the money, withdrawing his deposit from the bank and keep that money in the form of cash, isn't it? Isn't it? Now, if everyone is going through that setup, if everyone says during the festivals, obviously we need cash during the festivals, right? Because we have to distribute the sweets, we have to give it to your friends and whatever the purpose it is, right? And so what the bank says, the bank says if everyone is going to take their money out of their deposits, then what is left with the bank? Nothing will be left. And what is the impact? That if nothing is left with the banking system, sir, which is the backbone of an economy, the liquidity will be hit, the liquidity will be affected, right? So what the bank says, if during the the festival season and all, the expected deposit outflows are going to be high, he says if it is expected that the deposit outflows are going to be high, then he says the RDR should also be high. We should be keeping more money as the reserves to maintain the liquidity, right? To maintain the liquidity. Clear? Now this commercial banks part is very, very important. Till now we are discussing about this only. The central bank is just very simple. Stock of high powered money. That how much is the currency that is going to be there. That is known as high powered money, which is given by the central bank. But this commercial bank is little bit, the trickier one to understand. That how to maintain the RDR. Then RDR has cost and benefits, right? And the various parameters on which the decision is taken, what should be the RDR, whether it should be increased, whether it should be decreased. So all these factors contribute a lot. So with all this discussion, there is a concept that arises here, that is the credit multiplier. Credit multiplier. Now he says the credit multiplier is 1 divided by RDR. Sir, what does it mean? Sir, if the bank says that you have to keep 20% as the RDR, then how much of the money you can give on credit? Only 8,000 rupees, right? The bank says you have a deposit of 10,000. Out of this deposit, you have to keep a RDR of 2,000 rupees, and you have the money available for lending, that is for credit purposes. You have the money, how much? 8,000, right? Now, which money will multiply? 8,000 will multiply or 2,000 will multiply? Sir, this 8,000 will multiply, isn't it? This will go into the credit economy. This will be given as a loan to someone, that someone will again spend that money. Then again, it will go into the economy as the money supply. So this credit money, 8,000 rupees, is going to the economy and it is going to multiply. We say there is an inverse relationship between credit multiplier and RDR. Why? If this RDR keeps on increasing, if this RDR keeps on increasing, the money which is available for the credit multiplication, that will be low. That is why it is credit multiplier is equal to 1 divided by RDR. What does it show? It shows the inverse relationship. It shows the inverse relationship between RDR and credit creation and multiplication. credit creation and multiplication by whom? By commercial banks. Multiplication by commercial banks, right? So whenever the credit multiplier is there, the credit multiplier is equal to 1 divided by the required deposit reserve ratio. Clear? Any doubts in this thing? So this was all about the role of or the behavior of the commercial banks in creating the money supply, right? The RDR is there, R is there, E is there, then cost benefits are there dependent upon the two major variables, market interest rate and the expected deposit cash outflows, then the credit multiplier, right? Now comes the third one, that is the public. So how the public behavior helps in determining the money supply? He says, let's say Mr. X gets a salary of Mr. X gets a salary of 50,000 rupees. Now, Mr. X says that out of this 50,000 rupees, 30,000 rupees I will keep with myself as cash, that is liquid money, and 20,000 rupees I am going to deposit in the bank. Now, is this cash going to multiply? No, sir. This is not going to multiply, right? This is not going to multiply. So this is known as cash deposit ratio. This is known as cash deposit ratio. That how much percentage of the total deposit the cash holding by a customer or by the public is, right? So higher this cash, lower will be the money supply. Higher the deposit, more will be the money supply. Clear? So that is why we say that money supply is dependent upon the behavior of the public also, right? So this is cash, or we call it as currency held. Now it is denoted by the small c. It is denoted by small c, and it is known as what? Denoted by small c, and this represents what? This represents the capital C, that is the currency held by the public and the deposits, right? And the deposits, right? So this is how this equation comes into play, and this is how the behavior of the public helps in determining the money supply. When we talk about this particular C, higher C, lower money supply, right? Higher C means lower money supply, and if the deposits are higher, we say higher D. Higher D means higher money supply. Clear? So these are the three types of behaviors on which the money supply is dependent, and that is what is given here. The determinants are also there, right? Determinants also mean the same thing, sir, right? Then the detail of the determinants is money multiplier approach to money supply, that the stock of high powered money, this is the behavior of the central bank, right? Then the ratio of reserves to deposits, that is the RDR, behavior of the commercial banks in determining the money supply through credit money, right? So this I have discussed everything from here. Credit multiplier we have discussed. Then ratio of currency to deposit, behavior of the general public in determining the money supply. They influence the nominal demand deposits of the commercial banks by their decision in respect of the amount of nominal currency in hand, right? That is designated as currency ratio. It is the ratio of the money held by public in the form of currency to that they hold in the demand deposits with the banks. Clear? So 30,000 they want to hold in cash, 20,000 they want to hold in the form of deposits. The ratio between that is known as currency ratio, or it is known as currency to deposit ratio, cash to deposit ratio, CDR, right? So by various names it can be known as. It is known as cash deposit ratio. It is known as currency deposit ratio also, right? So cash here means the currency only, sir, nothing else. The cash here means the currency only. So all these things, with that what we have covered is we have covered all these topics, right? We have covered these 3-4 pages in particular diagram. Now comes the concept of the money multiplier. Now, what is money multiplier? Money multiplier represents how much of the money supply will change for a given change in the high powered money. He says if the central bank increases the high powered money, what will be the impact of that? What will be, just try to listen to it very carefully, what will be the impact of that on the money supply? Sir, we studied the three behaviors, but why are we talking about the central bank only? Because that is the primary source of the money supply, right? And other sources are dependent upon the primary source. So when we are trying to build the relationship in terms of money multiplier, we say the response of the money supply, how much of the money supply will change if there is a change in the high powered money. It indicates what multiple of the high powered money is converted into money supply. Increase in high powered money that goes into cash is not multiplied. On the other hand, the increase in high powered money that goes into supporting deposits is multiplied. Very simple, sir. If the RBI says, let's say there is Mr. Ram, who is an employee of RBI, right? Now, earlier he was getting 40,000 as salary. Now it has been increased to 50,000. Let's say this is the high powered money by the RBI, right? So the RBI has increased the high powered money by 10,000 rupees. Now, Mr. Ram earlier was saving 20,000 rupees and depositing 20,000 rupees in bank. Now he says, I will save 30,000 rupees as cash in my pocket and deposit 20,000 rupees. Will there be any impact on the money supply? No, sir. Right? Earlier also, this money supply was going to be 20,000 through the commercial banks lending. Now also it is going to be 20,000. This excess high powered money which has gone into the form of cash only, it is not going to multiply, sir. Is it going to multiply? No, sir, it is not going to multiply. So money supply is defined as M is equal to M into MB or H, right? That total money supply is dependent upon the high powered money, that is the money which is given by the central bank, and the money multiplier, that how many times this high powered money will be multiplied, that determines the money supply, right? And if you want to calculate the value of the multiplier, how can you calculate the value of multiplier? That is the money supply divided by the monetary base, MB or H. Monetary base means the high powered money. Clear? And how this circle consumes, just read this example, that how the money is being multiplied. This is basically the process of borrowing and lending, which I have already explained. Borrowing and lending by commercial banks, borrowing and lending by commercial banks, right? Keeping in consideration the RDR, right? So you will just go through this example and you will understand how this money is being multiplied, right? Now this 20,000, this will be available with this commercial banks for the lending, but this Reserve Bank says you have to keep 10% as the reserves. So what will be the available amount? 18,000 will be available for lending. They will lend this amount to some other person. Some other person will deposit in his bank. Then again the reserves will be taken. So this process goes on and the money keeps on multiplying, right? The money keeps on multiplying. Right, sir. Okay, let's go through this example so that I have to explain one thing. He says, assume A, B, C, D are individuals. One second, sir, one second. A, B, C, D are individuals and X, Y, Z are the banks. A earns 1,500 and after holding 500 rupees as cash, he deposits 1,000 in the cash at bank X. So it is the initial deposit, 1,000 rupees. Now, if the required reserve ratio is 10%, the bank X will lend 900 to B, because 10% is to be kept with the central bank. That is, it deposit 900 in the B's account. Now, B can use this 900 rupees. Now, B buys some goods from C and pays 900 to C's bank, right? Y, which is the C's bank is Y. Now, the bank Y will have an increase in the cash of 900, which may lend 810. Why? Because 10% is to be kept as RDR. So this process continues. And this is the known This process continues infinitely and the banks thus create the money supply called the credit money. Now he says if you are initially depositing 10,000 rupees, right, how much it will be multiplied? And sir, it will be dependent upon what is the your required reserve ratio. And this credit multiplication with the required reserve ratio has an inverse relationship, right? So that is why it says 10,000 divided by 10%. The credit multiplier, we studied about credit multiplier, that what is credit multiplier, right? 1 divided by required reserve ratio. Now I say this credit money is 10,000. If it is 1 rupee, 1 divided by required reserve ratio. If it is 1,000 rupee, which is put into the credit economy, right, and dependent upon the required reserve ratio, dependent upon the inverse relationship between the two, how much will be the money that will multiply? It will multiply to 10,000 at some point of time, right? So the initial deposit of multiplies itself by 10 times. Now there is another derivation which your institute material has, right? Someone might say that, sir, institute has given it in a different way. Not a different way, right? They have give you a derivation which I am going to again teach you, right? Which is very simple based on what we have studied so far, right? Now, let's try to see what is that derivation. What is that derivation? One thing here, for the derivation purposes, what he has done is, we are going to take money supply as capital M and this monetary base or the high powered money as capital H. Okay. You can take it as MB also. I'm going to take it as capital H as given in your module. Now he says money supply is dependent upon what? He says money supply is dependent upon two parameters. That is, money supply is dependent upon one thing, that is the currency plus the deposits, right? Currency plus the deposits, right, sir? Then he says the high powered money, either these are the deposits of the banks also, right? And what is the currency being there? Then he says the high powered money is dependent upon the currency plus whatever the reserves are there. Currency plus the reserves. Any doubts in this thing? Right? Currency plus the deposits and high powered money is currency plus the reserves. Now we studied about the behavior. We studied about the behavior of the public, right? So what was the behavior of the public? Now the behavior of public was given by small c is equal to capital C divided by D, right? Now I can rewrite as that what is the currency? Total currency is that C, what percentage, C is what? C is the percentage of the money held as cash, right? So if I want to calculate the amount, what is the amount that is held as cash? I will say the percentage multiplied by deposits. I can do that, sir. And this reserves is what? This reserves is nothing but my small r, right? Now, if I say I want to find this amount, now what will I do? I will substitute this value of C here, right? I will substitute this value of C in equation 1. So I'll write it as equation 1. I'll write it as equation 2. I say substitute value of C in equation number 1, right? So what will be your equation? That is M is equal to C capital D plus D, or it can be written as D C plus 1, right? This is small c. The small c represents the percentage of the cash and capital C represents the amount of the cash that is being held as in the form of the liquid money or in the form of cash. Clear? Any doubts up till this point? If you have any points up till this point. Now, further, sir, one correction here. This is not small r. When we are talking about this amount, this is capital R. Small r is again what? When you talk about small r, this small r is where this small r is what? In the percentage form, right? We are talking about, and C is again what? C is also in the percentage form, right? So here we are talking about currency plus the reserves. This is, we are talking about the amount, right? Now, there is one more thing that we studied. We say the small r is dependent upon the reserves to deposits, right? Reserves to deposits. Now, if you want to find out the amount of the reserves, you can rewrite it as r is equal to small r into d. That out of the total deposits, what is the percentage of the reserves? If you multiply that percentage, you will get the amount of reserves, right? So now what I'm going to do is, now I'm going to do substitute value of C and R, that is the reserves, in equation number 2. So what will be that equation? The H, that is the high powered money. What is the value of C? That is small c into D, plus what is the value of R? Small r into D, right? So if I calculate this, I can write it as D into C plus R. Any doubts up till this point? I hope this much is clear. M is equal to currency plus the deposits, that is the money supply, right? How much you are holding in the form of currency and how much you are holding in the form of deposits. High powered money is how much of the is there in the form of currency and how much of that is available in the form of reserves which can be used, right? So then we studied about small c, that is the percentage of cash to deposits, and small r is the percentage of reserves to deposits. And what we wanted was, we wanted it in the amount form. So we substituted the values here. Now, what is the money multiplier says? What does the money multiplier says? Sir, the money multiplier says what? M divided by H. M is what? M is your money supply. This is what the concept of money multiplier says. Money supply divided by the high powered money. Divided by high powered money. Isn't it? H is what? H is the money base or the high powered money. Now, what is the value of M? The value of M here is D into C plus 1 divided by D into C plus R. So this D will cancel out. So this money multiplier can be written in the form of C plus 1 divided by C plus R. C is what? The percentage of cash to deposit ratio, that shows the behavior of the public, and C plus R is, C is again the percentage of the cash held in terms of deposits, and the R shows the percentage of reserves to be kept by the commercial banks with the RBI, right? So this is how the money multiplier works. Clear? So this is the derivation that is there given in the module itself. So how it has been derived, we have already discussed, right? Now he says, if there are excess reserves available, if excess reserves are available, how the excess reserves are calculated, we have discussed in this particular lecture only, sir. This E wala part, E part, this part, excess reserves to deposits, right? Now he says, if the excess reserves are there, then money multiplier will be, then what will be the value of money multiplier? He says the money multiplier will be C plus 1 divided by C plus E plus R, right? So if the excess reserves are there, you will add the excess reserves in the denominator, because the reserves are taken in the high powered money is taken in the denominator. So there you will take the excess reserves percentage. Clear? So this is how the money multiplier will be done, and based on this we'll be doing the practical questions in the next part also, and this is all what we have discussed, right? So in the next lecture what we are going to do is, there is one small topic, we are going to complete this chapter. We'll be doing the practical questions from your module, and there is one small topic, that is the impact of government expenditure on money supply, right? Not much of the relevance for this topic, a very small topic that we'll complete, and we'll be doing the practical problems also. Very easy practical problems if you have understood the concept what we have studied in this particular lecture also, right? And also in the part of measurement of the money supply. So based on that only, we have very simple practical problems in the ICAI module, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.